Hello, my name is Tom Vasallo with MRW Financial Brokerage, and thank you for participating in this episode of Long-Term Care Seed. In this episode of Long-Term Care Seed, we're going to review our long-term care planning summary. This is the summary you're provided once you have a case and you fill out the questionnaire. If you missed last week's episode of Long-Term Care Seed, we reviewed the Long-Term Care Planning Guide. This can be branded with your contact information, produced for your area of the country, and has 18 different integrated videos. This is a great tool to generate initial interest and for that initial fact-finding meeting you have with the client. Part of the Long-Term Care Planning Guide has this Long-Term Care Fact Finder. And when you complete that and get it back to our office, we're going to create the Long-Term Care Planning Summary. This long-term care planning summary gets into the specifics for your particular client, but there are some things we're going to reinforce with this. Just like the long-term care planning guide, everywhere you see a QR code, your client can either scan it with their tablet or phone if you print it to them, or if you email it to them, they can click on it to watch videos that are going to reinforce the concepts that we're discussing. There are a couple of things we want to reinforce. First of all, the need for long-term care. This is for a married couple that reaches age 65. There's a 49% chance they're both going to need care, a 42% chance that just one of them will need care, and only a 9% chance that neither one of them will need care. So it means there's a 91% chance that one or both of your clients are going to need care. And quite frankly, it doesn't matter who needs care. It's going to have the same impact on their retirement security and their retirement savings. One of the other things we really want to enforce is the cost of long-term care. So we're going to produce this based on your clients' ages and the area of the country they're in. This is based on myself and my wife, Cassie. I'm 55, she's 53. And as you can see in 2023, the cost of care, the blended care was $5,987. What that is that's the average of the informal care, home health care, assisted living, and nursing home. Most people, when they need care, don't go straight to the highest cost nursing home. So we average this together as someone moves through the continuum of care. Of course, we probably won't need care today. So we index that at an inflation rate of 3% and project it out to the joint average age of the couple, in this case at age 80, and that grows to $12,912 a month. This is highlighted in red because it's an important number. We are showing three different options when it comes to long-term care, and we're going to show all of them based on insuring 100% of that cost, 75% of that $12,912, and 50% of that $12,912, and you'll see how that works. One of the other things that we really want to spend some time in reinforcing is the fact that long-term care is not an asset problem. It's a cash flow problem. And this video will reinforce that there are costs and consequences when you're converting assets to cash flow. What if all of a sudden my wife and I are retired, I need care, and we need to increase our spending at a rate of almost $13,000 per month? What impact is that going to have on my wife, her retirement security, and her healthy retirement lifestyle? So when we put together the long-term care planning summary, we want to show three different product options. I'm a firm believer that if you don't show all three options and give the client the choice, someone can come in behind you and disrupt or at least create questions when it comes to their long-term care plan. The first is the liquidity option, where they're moving money from the right pocket to the left pocket, not really spending the money. At some point in time, they're guaranteed they can cash it in and get all of the money back. And that is the Securion Secure Care 3 product that we are illustrating in most cases. So when you go to page 2 of the long-term care planning summary, it's going to have the return of premium option in Securion Secure Care 3 product. If you zoom in, what you'll see is some details on the product itself. In this solution, it is two separate policies, one on the husband, one on the wife. And all of these are life insurance-based options, so we can insure domestic partners jointly as well. But with Securion, it's two separate policies. They each have a 6-year benefit period. It does have a 90-day elimination period. Since this is two separate policies, there is not a joint waiver of premium. And it does pay on a cash indemnity benefit. And one of the things you'll notice on each page is there's some cells highlighted in green. And those are sort of the differentiators or the decision points. I will use this cash indemnity benefit and at this point to explain the difference between cash indemnity and reimbursement, and also explain what the benefit triggers are. And it kind of goes like this. In all of these policies, they cover home health care, adult daycare, assisted living, memory care, nursing home, all levels of care, all care settings, custodial, intermediate, or skilled. But you can't just choose arbitrarily that you want someone to come in and cook and clean for you and have the policy pay. All of these plans have the exact same benefit triggers, and that's either your inability to perform 2 of 6 activities of daily living, so that's bathing, dressing, eating, toileting, transferring, or continence, or physically you're fine, but you require supervision due to a cognitive impairment. So as soon as your doctor can certify that you can't perform 2 of the 6 activities of daily living, or your doctor can certify you require supervision due to a cognitive impairment, then you can start getting the claim paid. In this case, we're trying to get to that age 80 benefit, which is the average time people need care, and do that as efficiently as possible. And what I mean by that is the lowest premium possible. With Securion, that means we're going to start off with a lower monthly benefit, but it's going to increase 3% compounded annually, whether you're on claim or not. And you'll see how that works. Then, of course, they have a Comdex rating of 96 and their AM Best and S&P rating. And this is the Securion Secure Care 3 product. Now, I'm going to go back to the first page and show them this monthly long-term care because we have to tie it together. And right now it's $5,987 a month. At my age 80, that's going to be $12,912 a month. So now I'll flip back to the Securion page and I'll move down to the bottom of the page here. And what this says, let me zoom in on it, is it's 100% of that blended cost. So we're starting off at $5,987 a month because it's increasing at a rate of 3% compounded annually. At our age 80, that's $12,912 per month. But I'll take this opportunity to explain that's if you wanted to insure 100% of the blended cost. I'm not a big believer in insuring 100% of the blended cost. If people have been through a long-term care loss or seen it in their family, they know some of your expenses are going to reduce if you need care. If you're to the point that you require supervision due to a cognitive impairment, you may not need your golf memberships anymore, your boats, you're not going to be traveling as much, you're not going to be eating out as much. That's why we show that here's what it would cost to insure 100% of that projected cost, 75% and 50%. What I'm going to do is I'm going to pivot up to the 50% of the cost. I don't want people to have sticker shock. But 100% was $12,912 a month. 50% is $6,456 a month. So that means we're going to start off with just under a $3,000 a month benefit. By mine and my wife's joint age 80, it's going to grow to $6,456 a month. That means we each have a $232,000 pool of money to spend for long-term care. That means joint age 80, it's $500,000. So combined, just over $1 million in long-term care benefits. If we don't need the policy for long-term care, there's a death benefit of $143,000 that goes on to our beneficiaries. With Securion, it is 2 separate policies, so it's $71,844 in death benefit each. Now, what is the combined single premium for this? It's $108,250. But this is the liquidity option, and what that means is on the single pay, day 1 of year 6, so after the policy's been in force for 5 years, and any time after that, it's guaranteed, I can cash this policy in and get the entire $108,250 back. So are we really spending that $108,250, or are we moving it from our left pocket to our right pocket to create over $1 million of tax-free long-term care benefit at our age 80? So what is the cost for this? Well, of course, there is a cost. It's an opportunity cost. If you had set that $108,000 aside in a CD or a money market as an emergency fund, you would have earned interest on this. In this case, you're just getting your premium back if you cash it in. Now, you don't have to single pay it. You can, for lack of a better term, finance it over 5 years or pay 5 annual premiums of $23,381. And when you get into the flex pays, it's always day one after you pay your last premium payment. So day one of year 6, you could cash it in and get every premium dollar you put in back. 7 pay it, day one year 8, you can cash it in and get all of your premium back. The longest payment period with Securion is a 15 pay, so it'd be $10,209 a month. That's $150,000 over the 15 pay period. By the way, the death benefit will increase to at least equal the premium that went in on a 15 pay. And on day one of year 6, you can cash it in and get all of your premium back. So once again, the client's not spending the money, they're moving it from their left pocket to the right pocket. It's a balance sheet move, but they're leveraging it into over $1 million for long-term care at their age 80, and of course that comes out income tax free. Now, many clients say, you know what, I'm never going to cash this in though. There's a death benefit that goes on to my beneficiaries if I don't use it for long-term care, and I don't want to cash it in. So the next option we show is what we call our leverage option. And what I mean by that, it's the maximum monthly benefit for the premium expenditure. And that's going to be nationwide, and it's their Care Matters Together product. And this is a joint policy for husband and wife. So it has a combined 8-year benefit, where Securion had 2 6-year benefits. I can't tell you which one's better until someone goes on claim. If I go on claim first and use up all 8 years, I would rather do that, leave my wife with no benefits, but leave her with 2 years worth of assets that I would have consumed, if I had the Securion product. By the way, what's the real risk in long-term care for a married couple? The real risk, because this is a cash flow event. Remember, the cost of care at my age 80 is a little over almost $13,000 a month. The real risk is when I need care, we increase our spending $13,000 a month, and my wife is still healthy with years left in retirement, trying to maintain her financial security and a healthy retirement lifestyle. Once I am gone, if my wife needs care and goes into, say, a facility, we can liquidate the house, redirect all of that cash flow that it took to support that house, redirect all the cash flow that we used on my retirement spending and a lot of her retirement spending towards her cost of care. So the real risk is when the first person needs care and we still have the cash flow demands of a healthy spouse. Nationwide Care Matters Together product has a 90-day elimination period, but the reason this is highlighted in green is once you satisfy that elimination period, the claim is paid retroactive to day one. They do have a joint waiver of premium, so as you'll see with Nationwide, we have a pay to age 100 premium, and if there is an active claim being paid when the premium is due, that premium is waived. It also pays on a cash indemnity basis. Now, I didn't do this when I mentioned it with Securion. I just described the activities of daily living, but here's the difference between cash indemnity and reimbursement. Securion and Nationwide both pay on a cash indemnity basis. As soon as you pull one of those benefit triggers, either the 2 of 6 activities of daily living or you require supervision due to a cognitive impairment, the claim starts getting paid for the full monthly benefit. You don't have to send in any receipts. It doesn't have to be with a licensed care provider. You spend the money however you want to spend it. With a reimbursement contract, the big difference is really in home health care is you would have to go to a licensed home health agency that would bill the insurance company, and then they would reimburse you up to the policy limits or the maximum cost of care, whichever is less. Once again, with Nationwide, the 3% compound inflation rider makes sense. You'll see with our next option, it's better to just buy the level benefit, but we are doing the 3% compound inflation. Again, no ratings and Comdex ranking of Nationwide. This is their Care Matters Together product, and if we look at, again, the 50% of the projected cost of care, what you'll notice is the $2,994 a month in benefit per person, which grows to $6,456 a month. That's what we equalized between the policy options is the monthly benefit. Because it's a cash flow problem, what we equalize is the amount of income tax-free cash flow that each one of these policies generate when you need care. It has an initial combined benefit of $319,000. So with Securion, we had two separate policies. They each had their own pool of money. This one grows to their joint age of 80 of $688,000, but that is a joint pool of money. If I use all $688,000, there's no benefits left for my wife. If I use half of it, half the benefits are left for my wife. The death benefit is $107,766. It is a survivorship death benefit, so it's a second-to-die death benefit. Where with Securion, we had two individual death benefits. We could be the beneficiary of each other's policy. In this case, we're ensuring if neither of us needs care, the value goes on to our beneficiaries. But look at the premium on the single pay. It's $78,388. It was over $100,000 with Securion. And we have a 5-pay, a 10-pay, a 20-pay. We even have a pay to age 100 option. It's pay to age 100 of the older insured. Let's just focus on the single pay. It's $78,388. If we look at the Securion Secure Care 3 product, that's $108,250. So we're $30,000 less premium. The difference is we don't have that return of premium benefit, so we can't cash it in, but we have the same monthly long-term care benefits and a survivorship death benefit. Sometimes people look at it and say, I understand that, but if I purchase this, I'm never going to cash it in. I'm not going to need to consume this in retirement, but for long-term care. That's why the Nationwide is called maximum leverage. We want to show one other option, and that is a lifetime benefit period, because Securion has a 6-year benefit per person. Nationwide has a combined 8-year benefit. Well, there are people that have been through cognitive impairments in their family, Alzheimer's disease, senility, Parkinson's disease, things like that. And those are what lead to the long claims. I personally have a client that's been on claim for 18 years. One America's Asset Care Plan is the only plan that has a lifetime long-term care benefit. So when we look at that plan, once again, it has a lifetime benefit. So that means it's an unlimited benefit account value. So once you go on claim, if you had to stay on claim for 15 years, 18 years, it's going to keep paying the claim. It does have a 0-day elimination period for home health care. If you went directly into a facility, the elimination period is 90 days. But for every day you receive home health care, it's going to help satisfy that facility care benefit. So as long as you receive at least 90 days of home health care, when you go into the facility, there's going to be no interruption in coverage. It does have a joint waiver of premium. It is a reimbursement policy. Now, One America did roll out a new product. It's not approved in all states yet, where you can get 75% of the acceleration benefit paid as a cash indemnity benefit. But more importantly, they have an informal caregiver benefit. So where the real difference when the rubber meets the road to cash indemnity and reimbursement is when it comes to home health care. And with a reimbursement policy, traditionally, you have to go to a licensed home health care agency that does the billing. With that informal caregiver benefit, that's not the case. You could hire an individual down the street that's qualified to provide the care that you want to provide. They don't have to go to a home health. They don't have to bill through a home health care agency, and they can they can provide care and be reimbursed for that care. Again, they have a Comdex rating of 96. Now, with One America, their inflation rider is just extremely expensive because of that lifetime benefit period. So what we choose to do is buy a level benefit. That's $6,456. If you remember, with Nationwide and Securion, it starts off at just under $3,000 a month and grows to $6,646.56 by our joint age 80. With One America, we're going to just have a $6,456 a month level benefit. What does that mean? If you go on claim before age 80, you're going to get slightly more monthly cash flow out of One America than you would the other policies. After age 80, it's going to be slightly less. If you went on claim exactly at the joint age of 80, it's going to be the same amount. It's just, with One America and the lifetime benefit, it's more efficient to buy that level long-term care benefit. It is a survivorship death benefit of $161,400, so it's a second to die. And look at the premium. It's going to be more expensive because it has that lifetime benefit of $120,477. Of course, there's a 5-pay, a 10-pay, a 20-pay, and a pay to 95 option. With both One America and Nationwide, it doesn't have a full return of premium. You give out that liquidity benefit, but that doesn't mean there isn't a guaranteed cash surrender value, and there is, and it's approximately half the premium that went in. Eventually, after many, many years, it'll grow to more than the premium that you went in, but it's not a full liquidity benefit, say, day one of year 6, like there is with Securion. So what does this give us the ability to do? It really gives us the ability to narrow down what's important to our client. Do they really want that liquidity where they're moving money from the right pocket to the left pocket, just looking at the single premium here because they all have flexible premiums, but that'd be $108,250 to cover 50% of the projected cost. Or are they more interested in the leverage? They decide, I'm never going to cash it in, and there's the death benefit there that passes on to my beneficiary, so then I'm going to go Nationwide with their Care Matters Together product. I'm going to save about 30% in premium going in. And if I did cash it in, I'm going to get about half of that back anyway. So it's not like the $78,000 is gone. It's just you can't cash it in and get every single nickel back day one of year 6. Or maybe we've experienced long confinements in our family and we really want that lifetime benefit. That's going to be a little bit more at $120,477. By showing all 3 options, now we can have a conversation, an intelligent conversation with our clients, narrow it down to what's most important for them, dial into, I like to say here in Florida, the juice has to be worth the squeeze. Hey, listen, I wish everyone would insure 100% of the projected costs, but it just doesn't make sense to do that a lot of times. I have clients on claim today that are getting $1,500 a month from a long-term care policy. I sold them 30 years ago. And yes, when they have the crystal ball and they knew they were going to be on claim, they wish they had purchased more. But you know what? None of them are upset they're getting that $1,500 a month. In other words, something is better than nothing. So we can dial into, do you want to insure 50% of the projected cost, 75%, or 100%? And those are just starting points in this summary. We can dial it into whatever benefit or whatever premium they are comfortable with. The next thing that we're able to sort of narrow down for them are the payment terms. All carriers will accept a single pay, a 5-pay, or a 10-pay. Some of the 10-pays get limited with some carriers as you get older. Some carriers also, like Securion, have a 7-pay and a 15-pay option. One America and Nationwide have a 20-pay option. One America has a pay to age 95 of the older insured, and Nationwide has a pay to age 100 of the older insured. So once again, it really, it really matters how they want to fund it. But we literally have to put together over 20 illustrations to prepare this long-term care planning summary. And it doesn't make any sense to dump a telephone book worth of illustrations on your client to have them try and parse through it. We can go through this long-term care planning summary, narrow it down. Do they want the liquidity? Do they want the lifetime benefit? Or do they want the leverage? Let's assume maybe they want the Nationwide leverage and at 75% and they want a single pay option. Now we can narrow it down to the 1 or 2 illustrations that they want to compare to each other when we get into the details. So this is the great second meeting long-term care planning summary after we've reviewed the long-term care planning guide. If you didn't see last week's long-term care seed, you can watch the recording of that. Next week, what we're going to cover is the Pension Protection Act. And what is the Pension Protection Act great for? Those clients that have a non-qualified annuity with gains in it and they feel trapped in it. In other words, it's the type of client that's mad they got to take their required minimum distribution because it just forces them to pay income taxes on it. Of course, that non-qualified annuity is taxed last in, first out, so any money they take out is considered interest and taxable. And this is an important concept. Annuities don't have any type of step up in basis, so when they pass that annuity on to their beneficiaries, they're passing on a deferred tax liability as well. And that's fine. They're passing the asset, to pay those taxes. But they're probably never going to touch that annuity because of the tax consequences during their life. Because of the Pension Protection Act, we can leverage it into an annuity qualified for that, triple the value for long-term care, cover both husband and wife, and they can access that non-qualified annuity for long-term care income tax-free. Just think about that for a minute. I see all of the time where people are liquidating capitally appreciated assets in a managed account, paying capital gains tax on it to fund long-term care, and they're not touching an annuity. So those capital gains taxes, which if it had passed on to their beneficiaries would have a free step up in basis and be completely avoided, they're paying capital gains taxes on it, and they're passing a deferred tax liability on in that annuity. Let's reposition that annuity, which may be a dormant legacy asset in their minds, into one that will still pass on to the beneficiaries if they don't need it for long-term care, but if they do, we can triple it in value and access all of that income tax-free. So that'll be next week's long-term care seed. Once again, my name is Tom Vassallo with MRW Financial Brokerage. I can be reached at 813-875-6331. We can personalize all of this material with your contact information, and I'm here to support you in any way possible. Thank you, and have a great day. Long-Term Care Seed is MRW's weekly 10-minute long-term care sales chat. We want to give you a seed you can plant with a prospect that will grow into a revenue-generating long-term care planning opportunity.